The next learning objective is to account for the purchase of inventory using a perpetual system. So in this system, we're going to be perpetually updating inventory. So the inventory account is going to be increased every time we purchase inventory. For example, here's a journal transaction where we're going to purchase inventory on account for $1,000. So what's going to be the debit account? Well, since we're buying inventory and inventory is an asset, the cost of inventory is going to go up by $1,000. And because we're buying it on account, accounts payable is also increasing. And remember, the A plus means it's just reminding you. It's the author's way of reminding you that inventory is an asset and it's going up. And the L means accounts payable is a liability and it is also going up. So we purchase inventory on account. Now, if there was other costs associated with the inventory, such as sales tax or shipping, that also increases the cost of the inventory. So it's just simply put in the inventory account also. There is no separate account for sales tax or for shipping. It all goes in the cost of inventory. So now let's look at an example of an invoice. The cycle of merchandising begins with the purchase of inventory, and the inventory account is increased each time merchandise is purchased. So this invoice is a seller's request for payment from the buyer. It indicates the quantity and cost of the items purchased. The cost of inventory is also impacted, as we said before, by shipping costs, and it's also affected by returns. Obviously, if we return inventory, then the inventory account is going to go down. And if we get a discount for early payment, which we'll explain later, that also would lower the cost of the inventory. But let's look at this purchase inventory. Let's look at this purchase invoice. So the seller is Southwest Electronics Direct. So they're the supplier, and Smart Touch Learning is the purchaser. So we must work for Smart Touch Learning since we're the ones purchasing this inventory. And it happens to be purchased on June 1st, invoice number 410. And then here we have credit terms, 315 net 30. So what this means is if we pay this invoice within 15 days of the invoice date, so by June 16th, if we pay it, we will get this 3% discount. So we would remove 3% from our price. Otherwise, the net amount is due within 30 days. And then it looks like we purchased 100 touchscreen tablet computers at $350 each, so a total of $35,000. So when we purchase this on account, the cost of our inventory would be this total down here. So if there was shipping, we would still use the total. If there was handling, we would still use the total as the cost of inventory and place that in our inventory account. Now down here, sometimes the seller will be nice to you and they will calculate how much is due depending on what dates you pay. For example, remember we get 3% off if we pay within 15 days. So they've done the calculation for us. So they're saying if we pay by June 16th, which is 15 days from this date, then we only pay $33,950, which is this $35,000 minus 2%. So as we said, inventory, the cost of inventory is also affected by shipping costs. So that's going to go directly into the inventory account. So if our inventory costs $100 and there's $2 of shipping, we're going to place $102 as the cost of our inventory. And if we return some purchased items later, that's going to decrease our inventory account. Now remember, the inventory account contains the cost of the inventory. It doesn't contain the amount that we think we can sell it at. It's just the cost. And remember that $35,000 invoice from the previous slide? So if we paid early and got a discount, that discount would lower the cost of the inventory, because the inventory did not really cost us $35,000. It cost us amount less than that. So we would have to lower the cost of the inventory account. So let's look at those purchase discount numbers in more detail. So on the invoice, you might see something like this, credit terms. These are called credit terms. It might say 2/10 N30. So what the 2/10 means is if we, the buyer, pay the invoice within 10 days of the date of the invoice, we're going to get 2% off. Otherwise, the net amount, which means the full amount, is due within 30 days. Now, if the company who is selling it to us does not want to give us a discount, they just might say N/30, which means you're not going to get any discount and the net amount is due within 30. Or it could say EOM, which means the bill, or the invoice, I should say, is due at the end of month. So now let's look at the journal entry for paying off our inventory. And let's say the terms were 210 net 30. And we're going to pay within the 10 days, so we're going to get 2% off. So we already recorded the original purchase, which was inventory going up with a debit by 1,000, and then AP going up with a credit by 1,000. Now we're going to pay it off. So when we pay it off, we have to get rid of the full amount of AP. So we lower accounts payable by the full amount. And then so if we have a $1,000 invoice and we're going to save 2%, how much are we paying? Well, we're paying 98%. So we're paying $1,000 times 98% equals 980. And then what do we do with the discount? What do we do with the $20 that we're saving? Well, that's going to lower the cost of inventory. So we have to lower the cost of the inventory account by the amount of the discount. Because the inventory really cost us $980, but when we purchased the inventory earlier, we put this $1,000 in the inventory and the AP account. So our inventory account, before lowering the cost of inventory by 20, says that inventory costs us 1,000, but it didn't really cost us 1,000. It cost us 980. So we have to lower the cost of inventory with this $20. Now, technically, when you're doing this transaction for rounding purposes, you officially have to calculate this discount first. And then the amount that you're going to pay is going to be the liability minus the discount. So again, in this scenario, you would calculate this discount, $1,000 times 2%, record it, and then the cash amount that we're paying is 1,000 minus the amount we're saving, which is $20. Okay. Now let's look at purchase returns and purchase allowance. So a purchase return means we purchased something and then later we returned it. So because it says a purchase return, that means we did the purchasing originally. This is as opposed to a sales return. A sales return is when we made the sale and a customer returns it to us. So if it says purchase returns, it means we purchased it being inventory, and then later we returned it. So merchandise is returned by the purchaser to the supplier. Why did we return it? Well, it might be they might have sent us the wrong color, they might have sent us the wrong amount, it might have been damaged, etc. So purchase returns are pretty common. I'm sure you bought some jeans and then had to return them later. So for you, that would be a purchase return. Now, a purchase allowance is a little different. That's when we go and purchase some inventory, and then later the seller, our supplier, gives us an allowance, which would mean it would reduce the cost of that inventory for us for some reason. And here's a common example. Let's say we sell washing machines. And then we order some washing machines from the supplier, and they send us the washing machines, and then one of them has a dent in the back. So we call up the supplier and we say we want to return this dented washing machine. And to discourage us from returning it, they might say, well, the dent's in the back and it's just superficial. No one's going to see it. Why don't we give you $200 off and you just keep it? So when they lower our bill by $200, that's called the purchase allowance. So it's an incentive for the purchaser to keep the goods and avoid returning it. So let's do a journal transaction for a return. So when we return an item that we purchased on account, we just need to reverse the purchase entry. So AP is going to go down instead of going up, and our inventory is going to go down instead of up. So we've just reversed the purchase entry. This decreases both accounts payable and inventory. Now remember, when we are reducing inventory here, we're reducing the cost of the inventory. We're not keeping track in the journal of our quantity. In the real world, our accounting system would also keep track of the quantity behind the scenes.